Well, the really big change, you could call it the crisis for the family business sector, is the reform of business relief for inheritance tax. And this affects agricultural relief as well, if that's relevant to anybody's business situation. So previously, we had 100% relief for the value of a business passing to the next generation. And the limit of that relief now has a new cap of £1 million. So the first 1 million can pass free of inheritance tax. Any value in excess of the million is going to be taxed at 20%. And this is massive for the family business sector. Most of these businesses would never be sold. Where's the money going to come from to pay a significant, maybe, inheritance tax charge? On the plus side, the instalment basis for inheritance tax is likely to be available, but the devil's in the detail, and we're talking to you hot off the press here, so we'll need to look at exactly how that applies. But assuming it does, then families will have 10 years to pay the inheritance tax charge, or likely on an interest-free basis. But still, it's a big tax charge where previously we expected there to be none. Well, there was certainly lots of talk in the media about a possible increase to capital gains tax, and we were all poised for something quite dramatic. Rates have gone up, but perhaps a bit less than maybe lots of people feared. So the main rate of capital gains tax for a higher rate taxpayer has increased from 20% to 24%, and it's up to 18% for a basic rate payer. So that brings the capital gains tax rates in line with those for residential property disposals, which certainly simplifies things a bit. But we also have some changes to the capital gains tax relief, business asset disposal relief, or BADR. So this is often interesting to family businesses who might be thinking about a sale, whether that's a full or a partial sale for the next generation. Rates for BADR have reduced a lot over the years, but currently, today, we have £1 million where the capital gains tax rate is an attractive 10%, and that's a good reduction from the main rate of 20%. That's going to change from April, where we'll see an increase to 14% for the first £1 million of gains, and then up to 18% from 2026. So a bit less generous, but still perhaps a differential there of 6% for a higher rate taxpayer. So still worth having, still beneficial for entrepreneurial clients. Another big headline grabber that the government have had in the lead up to this budget is saying there'll be no tax increases for working people. And Rachel Reeves was very keen to tell us how she was standing by that promise. But what there has been a tax increase for, or will be a tax increase for, is the employers of those working people. And we have an increase of 1.2% on employers' national insurance. So the rate from April 25 will now be 15%. But perhaps more dramatic and perhaps less expected than that was we have a reduction in the thresholds. So now employers' national insurance will be payable on any salary in excess of £5,000. So for every employee in your family business, that alone is an increase of £600 extra national insurance. We did think maybe there'd be something in the detail about a change to dividend tax rates, but hot off the press, it's not there. So I think for cash extraction from your family business, the needle is swinging perhaps back a bit in the favour of dividends. But again, it'll be one of those number crunching exercises to see what works best for your business. Something we have also on the business, the corporation tax side, is a new corporation tax roadmap, which is intended to bring certainty for corporate business structures. And that in particular has a freeze on the corporate tax rate at 25% until 2030. And also announces there'll be no changes on other valuable reliefs such as research and development, the full expensing and the annual investment allowance. So I think that gives us some comfort that what we're doing in corporate structures will be the same for at least the foreseeable future. Well, there was another announcement on inheritance tax, which I think will be very interesting to many of our family business clients. And that's the change to the way that pension pots are taxed on death. So at the moment, it's possible to pass on a pension that you haven't drawn onto beneficiaries, and that passes outside your estate, so inheritance tax free. And I know that many clients have taken opportunity to use that planning to pass on pension savings to children who they'll be able to draw as their own pension savings in the future. Well, for anybody who is planning to not die before 2027, it'll be time to reconsider that strategy because pension savings will no longer pass free of inheritance tax from April 2027. So it's time to seek some financial advice and think about how you best make the most of your pension before that time.